Mortgage tips you should know, brought to you by Affinity Partnerships. Your home is going up in value, and you've been paying off your mortgage. As these events occurred, you've created equity in your home, which can be used. One of the ways to use the equity is with a home equity line of credit, or Heloc.
A Heloc is an acronym for Home Equity Lines of Credit. It's a very useful tool so somebody can actually access the equity in their home and be able to use it for whatever purpose they want.
How does it work?
A Heloc is a pretty basic financial tool. So what it allows you to do is take the equity out of your home. So the first process is to contact a licensed mortgage professional who handles Helocs, and they are able to look at what your house is appraised for and then allow you to be able to extract a portion of that equity as funds that you are able to utilize for whatever purpose you want to. So it's a very quick, it's a less expensive process than, let's say, a cash out refinance. And what's really neat about a home equity line of credit or HELOC is that you don't have to use the funds all at the same time.
What does it take to qualify?
Qualification for a HELOC is generally a determination that's made based on sufficient equity so that the lending institution has enough security or collateral to be able to give you that type of loan.
HELOC versus cash out refinance.
The difference between a cash out refinance and a home equity line of credit are pretty distinct and clear. On a cash out refinance, you receive the money as a lump sum. So let's say, for example, I took $100,000 as a cash out on my equity in my home. I would begin paying that interest on that full $100,000 from the beginning. However, if I took out a home equity line of credit instead of a cash out, I would only be paying interest on the amount of money that I used on that line.
You can visit these websites to learn more about the participants on this edition of Designing Spaces.